We are, you could say, in an inverted economy, a through the looking glass economy, a Fed distorted economy. And so longer term, yes, gold is an inflation hedge. I mean, just look at a 50-year chart of gold versus the dollar since 1971 when they were freed to trade. And it's a giant X shape. Like, gold tends to lead inflation. I think what we're seeing is a lot of people around the world, not just the Chinese, hedging against that inflation that's coming with gold.
Growing expectations that the Federal Reserve will begin its easing cycle in September are creating a strong tailwind for gold. Many analysts see last month's record highs as a minor obstacle in the current uptrend. The Consumer Price Index, CPI, fell minus 0.1% last month after May's flat 0.0% reading, the U.S. Bureau of Labor Statistics said on Thursday. The latest inflation data was better than expected, as economists were looking for a 0.1% increase. Lobo Tiggre, editor of the Independent Speculator, speaking at the Rick Rule Symposium in Boca Raton, Florida, emphasizes that although certain market movements are anticipated and signaled by entities like the Fed, there is always a chance they won't happen as expected. Addressing the concern of whether deflation is bad for gold, Tiggre acknowledges that gold is traditionally seen as an inflation hedge. The gold market is seeing a strong bullish reaction to the better-than-expected inflation data. Despite the risk-on mood and modest U.S. dollar strength, the gold price maintained its upward trend. Gold has recently managed to settle above the $2,400 level and is moving towards the $2,450. Spot gold was up 1.8% at $2,414 per ounce, its highest since May 22nd. U.S. gold futures rose around 1.6% to $2,418. World Gold Council data shows that physically backed gold ETFs enjoyed monthly inflows of $1.4 billion in June. Despite gold being an inflation hedge in the long term, as evidenced by its historical performance since 1971, Tiggre believes people expect it to react immediately to current events. He explains that when the Fed cuts rates, it often responds to economic weaknesses, which can be bullish for gold. Before we jump into more content, consider subscribing and enabling notifications to stay updated with our latest uploads.
One of the things, the questions that was coming up was it priced in? Like, these rate cuts are so telegraphed that, maybe that we're already flirting with 2,400 shows that it's already priced in. Well, today's price action shows you that no, it's not priced in. And this is actually a takeaway for the audience. You'll see a lot of things that are, like clearly written in the, on the wall, and it's coming, it's signaled by the Fed or whoever it is. But the actual reality, there's always a chance it won't happen. And so there's an arbitrage. And that arbitrage closes when the reality happens. So sometimes even a print that's as expected causes a market movement. Now, in this case, it was better than expected if you're fighting inflation. And so we saw a pretty dramatic response immediately. And to be expected, right? The moment that print dropped, I was thinking, Mr. Market's going to like this. So I took a screenshot and I was posting my thing. And then as I'm typing it, I see, Market Watch, the futures goes like this. So I was able to do both at once. Yeah. But wait a minute, Lobo, if you're a gold bug, isn't deflation bad for gold? Gold's an inflation hedge, right? I knew you were going to ask me that.
What happened to the inversion?
We are, you could say, in an inverted economy, a through the looking glass economy, a Fed distorted economy. And so longer term, yes, gold is an inflation hedge. I mean, just look at a 50-year chart of gold versus the dollar since 1971 when they were freed to trade. And it's a giant X shape. Like, there's really no question longer term. The devaluation of all these funny little pieces of paper we call money versus real money, there's no debate there. The problem is that people want gold to do what they think it should do today, right now, right? So gold tends to lead inflation. I think what we're seeing is a lot of people around the world, not just the Chinese, hedging against that inflation that's coming with gold. Because, you say, we've got deflation and the Fed's going to cut. Well, why is it going to cut? Well, because it's responding to its other mandate. It's trying to prop up a weakening economy. And sorry for the long-winded answer, but this is the point, is bad news is good news. The Fed has trained, and the central banks of the world have trained investors that bad news is good news. And so what we're seeing from the mainstream perspective is another bit of bad news. Like, deflation is supposed to be bad. Yes, the voters are upset about inflation, but we don't want them to lose their jobs. Right. So we're in that rock and the hard place coming together here. And people make a big fuss about this, but the reality is that the so-called core number that they are saying that they're guiding their decisions on hasn't budged. We're still over 3% on the core, 3.3, I think, on the core, which supposedly they make their decisions on. So people can talk, oh yeah, we're close enough, we're close enough. But if the Fed's cutting and inflation is still, their chosen metric is still above 3 plus, they're moving the goalpost. I think that's really significant, and I think that's really bullish for gold bulls.
U.S. consumer prices unexpectedly fell, and the annual increase was the smallest in a year, reinforcing views that the disinflation trend was back on track and drawing the Fed another step closer to cutting interest rates. Interest rate futures prices reflected about an 85% chance of a rate cut at the Fed's September meeting, compared with about a 70% chance seen before the data. Following the U.S. inflation data, the dollar dropped to a more than 1-month low, making gold more attractive for other currency holders. Tiggre points out that mainstream forecasts still expect 1 or 2 rate cuts this year, which the market views as bullish for gold. If he's correct, gold prices could rise significantly, and if he's wrong, they could still go up. Regarding investment strategies, Tiggre prefers gold, silver, and uranium for their resilience in a recession. Let's now turn our attention to the video again.
I don't think we just get the 25 basis points in September and then maybe another one in December that they're talking about. I think we're seeing real unfraying of the labor market, which has long been that pillar holding the consumer up, right, in the U.S. That is the support for U.S. exceptionalism. And it's not just the last, and since we spoke, we've had 1 or 2 labor prints. It's not just the last one that shows weakening the labor market, but the one before. And the JOLTS numbers and never mind the household survey instead of the one that they quote all the time. Like, there is clear evidence of weakening in that one support for American exceptionalism in the economy. So I think the evidence is actually coming around to my view. And all those people saying if we don't have a recession by now, we're not having one, I think I'll be shown to be right about that by the end of this year. And I think it's starting now. As you and I sit here, I think it's starting. The data is showing it's starting. And the CPI print may fit that. But let's say I'm wrong. Lobo, you're just a tinfoil hat wearing gold bug and, it's always gold to the moon for you, right? Okay, let's say I'm wrong. Well, the mainstream is saying 1 or 2 cuts this year. The Fed is saying 1 or 2 cuts this year. And the market reaction we've got today, back over 2,400 in gold, is saying that's bullish for gold anyway. So, I don't want to say that it's impossible for gold to go down. But if I'm right, if I'm wrong, it goes up. And if I'm right, it goes way up. I'm not ready to buy any industrial minerals until I'm sure the recession has done its worst. We've talked about this before. Right now, for me, it's gold, silver, and uranium, because uranium is recession resistant at the very least. Everything else, I'm waiting to be sure that the recession has done its worst, or that I've been proven wrong about that, which will be this year one way or the other. So when that time comes, sorry, it's not nickel, because the Asians have figured out how to supply nickel from non-class 1 nickel sources, and they're flooding the market. And we need to see whether or not that rebalances. Lithium is a maybe. High prices cure high prices. Lithium's not rare. Even with the low prices, there are still new projects coming online. So lithium's a maybe, not a no, it's a maybe. We'll see how the market balance is, because we're still building the EVs and stuff. So there still is a lithium story. But the no-brainers for me are oil and copper. I'm not going to wait to see how the market shakes out or whatever. As soon as I'm confident that the recession has done its worst, or that I've just missed it, there was no recession, this time was different.
Right. Which we'll call you out for.
Right. Either way, oil and copper stocks that will still be on sale at that point. The carnage will still be, people reeling. That's what I'm looking for as a buying opportunity.
Gold has appreciated, buoyed by last week's lower U.S. CPI data with the path of least resistance to the upside. Precious metal thrives in a low interest rate environment, and the mere anticipation of a rate cut by the Fed in September has reawakened gold bulls. The precious metal had been hovering around the 161.8% Fibonacci extension of the major 2020 to 2022 decline before the re-acceleration to the upside. Gold prices subsided after reaching a new all-time high in May as China, the world's largest purchaser of the precious metal, dialed back its monthly purchases. What's your outlook on gold prices for the next 6 months? We want to hear from you. Feel free to leave your thoughts in the comments. Give a thumbs up if you liked what you saw, and subscribe to stay connected with our ongoing exploration.